Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to continue the discussion on PE ratio. This video, I'm going to explain how can we actually use this PE ratio on DBS to find if the stock is still undervalued or overpriced in 2026. So this is one of the objectives that we want to meet. There are actually three key things that I want to discuss for this video. Firstly, I would like to explain the two different types of PE ratio, trailing PE ratio and forward PE ratio. I'm going to use them to determine whether DBS Bank is still a good buy or not. Next, I will use current PE ratio versus historical PE ratio of DBS in order to determine whether DBS is undervalued or overpriced. Last but not least, on the bonus, I'm going to discuss on the dividend, based on the trend of the dividend of DBS, whether the stock is still undervalued or overpriced. So this will be the objective of this discussion. Guys, before I continue, I'd like to urge you guys to help me by like this video. Just a few seconds, help me press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for your strong support. A quick disclaimer, this is not a financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you're willing to lose. With this, we are ready to kickstart today's discussion. This is what we have discussed previously. We actually also prefer a high PE. This is because we can anticipate a huge growth if the PE ratio is high. So this is the definition of a high PE ratio. On the other hand, we may also prefer a low PE ratio. This is because although a low PE ratio, this actually anticipates lower growth and with some form of risk. However, this can be a potential bargain. Let's take a look on this equation to understand better. For example, if the PE ratio is low, from here you can see that this is actually low. So therefore, the share price is also low. And with a lower share price with the same earning per share, this means that our ROI can be shorter. So this can be also ideal on the other hand. Now, I like to focus on the two types of price to earning ratio. The first one will be trailing PE ratio. The other one will be forward PE ratio. Let's come to the trailing PE ratio first. This is actually based on past earning and usually the last 12 months. As for forward PE, basically the earning is actually expected. So basically we need to anticipate what will be the future earning typically for the next 12 months. Coming to the formula to calculate trailing PE, the key difference is the earning per share will be based on the last 12 months. While the forward PE, again, the key difference is we are going to anticipate, we are going to estimate what will be the future earning per share for the next 12 months. Coming to the pro and cons, for trailing PE, they actually use actual reliable data. While coming to the cons, they actually look backward and may not reflect on the future performance. As for forward PE, they are actually forward looking. So this can be very useful when we are going to anticipate the growth. However, the con side, basically all these forecasts can be totally wrong. We can put what we have learned earlier on. So basically the trailing price to earn ratio and also the forward price to earn ratio on DBS to determine whether DBS is still a good buy or not. This chart here shows the share price of DBS for the last 5 years. You can see that at any point of time that you buy DBS, you probably will make a profit. So this is why DBS Bank is so bullish now. You probably will notice this PE ratio, 15.1. So you probably will ask, is this trailing PE ratio or forward PE ratio. So in order to do a deep dive on PE ratio, you need to do a more detailed report. For example, the report is actually, the link is actually over here. So from this detailed report, you can actually find the trailing PE ratio, which is 15.1, and also the forward PE ratio, which is 14. So from here, we have managed to obtain the trailing PE ratio and forward PE ratio. So in short, what does all this number actually indicate on DBS Bank? Next, I will explain how can we actually interpret the trailing PE ratio and also the forward PE ratio. So this is what we have discussed earlier on with a trailing PE ratio of around 15. This simply means that investors are willing to pay $15.1 for every dollar of the past earning. So next will be on the forward PE ratio. So on the forward PE ratio, which is around 14, okay, so basically this is again based on forecast. Okay, so with the forecast, DBS is expected to grow earning. Okay, so basically with a growing of earning, this means that the PE ratio will reduce. So from here you can see that the PE ratio actually reduced. So therefore, with confirmed growing, with all this data, we can easily conclude that with forward PE ratio less than trailing PE ratio, this usually signal expected earning growth, which is generally a positive outlook. So therefore, with this, DBS in fact is still a good buy in the year 2026. Before I continue the discussion on using current PE ratio versus the historical PE ratio of DBS Bank, okay, I like to urge you guys to help me by like this video. Guys, help me press the like button now. When more guys actually help me to press the like button, this video will have a better chances to reach out to a larger audience. So guys, help me press the like button now. For those who are new to this channel, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. Let me do a polling question. With what we have discussed earlier on, do you think that DBS is still a good buy or not? Or maybe suggest what price then you will buy DBS. Another question, out of these three banks, which one will be a better buy in the year of 2026? So guys, help me by commenting all this so that we can learn together as a learning community. Let's come into another topic of discussion, how to use current PE ratio versus the historical PE ratio to determine whether DBS Bank is still a good buy or not. So basically on this table here shows the different years, what is actually the PE ratio. The explanation of the situation is under the remark. So basically this is actually the historical PE ratio of DBS Bank. So this is in numbers, okay, you can easily find in terms of in a graphical way also. Okay, through this link over here, you can find all this information. Based on what we have seen just now, you can see that when the PE ratio is high or maybe consider high, okay, it will do some form of adjustment on the next year. Over here, you can see the same thing. So this PE ratio is also considered high. So after that, they will do some form of adjustment. Okay, so in the year of 2025, in fact, is the highest PE ratio among all this year. So I believe that there will be some form of adjustment, okay, in the year of 2026. If not, okay, the investors are still very bullish on DBS. So therefore, for DBS, the price to earning ratio will be still high. So what can we actually conclude from this? One thing that we can easily conclude is that the current trailing PE ratio of 15 is actually way above the DBS historical average. However, by having a high PE ratio, there is still a long queue of people queuing up to buy DBS stock. So this simply suggests that the market pricing in the structurally higher profitability. Okay, so this simply means that investors believe that DBS will earn money more consistently going forward. Next, okay, confidence in long-term ROE, return on equity improvement. Okay, this means that investors believe DBS can sustain higher quality earnings, not just a one-off boost. Last but not least, on the strong capital returns based on the dividends plus buyback. This means that investors expect more cash return to shareholder, making the stock more attractive. So basically, this is actually the PE ratio. Okay, what is actually the market interpretation? So basically, from here you can see that if a low PE so-called ratio, this means that it's actually a deep value, which means that this stock is worth buying. And this 8 to 13 is something that is so-called the fair. Anything above 13 is called a premium. So in short, investors are still willingly to buy DBS, but with a premium as compared to the past. With this, let's go to the dividend of DBS. In fact, one of the reasons why people actually buy DBS is because they actually guarantee a very attractive dividend. This table here shows the different years, what kind of dividends is actually shared with the shareholder. So from here, typically you can see that DBS can share the dividend as high as 10%, lowest is close to 4 with the shareholder. So this is one of the reasons why DBS is still a very attractive share. It's because they give up a very attractive dividend. So currently, February 2026, okay, the yield of the dividend is around 4.8 to 5%. What can we actually conclude from here? Okay, so now, okay, the yield for dividends is under the normal range. So DBS typically trade at a dividend yield of 4 to 6%. Okay, so at this range, this strongly reflect that we are going to have a strong earnings consistent, stable dividends policy. DBS Bank is actually a premium valuation as compared to the region peer. Coming to the long-term trend history, currently we are at 5%. So currently DBS is actually trading right at its historical fair value yield range. So basically with this, you can see that the dividends is now at the very fair, at the normal valuation. So with this is why DBS Bank is still bullish, although the price to earning ratio is considered high as compared to his historical value. This will be my last slide, and I'd like to do a quick conclusion on DBS. After all this discussion, what this actually means for investor. Okay, so in fact, DBS has evolved into a high quality income stock. Okay, so what does this mean? Okay, so basically, DBS has become a very reliable passive income by giving dividend, 5% of sustainable dividend yield. And also, earlier on, I show you the share price of DBS for the last 5 years. This actually guarantee a strong capital returns. The dividends grow actually driven by the structural earning strength. So basically, this is why DBS Bank is still bullish for the investor. Okay, so let's do a quick comparison, okay, with Singapore government bond, which is slightly lower as compared to the DBS. Although SG risk is higher, but if you still remember, for some of the good days of DBS, the returns can be at around 10%. So in short, DBS in fact offer a very attractive risk-adjusted income profile. So with this, I'd like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.